What we'll end up doing is I just want to talk about a couple of things real quickly that's going on in the grain markets. Obviously, one of the big things that starts happening this time of year is we start getting some of those early season planting projections for the upcoming season. So I'm going to step through that a little bit. The other one that I want people to be aware of today, unfortunately, we don't have the new supply and demand information. That'll come out at 11 o'clock. So that's going to be some new information on where the USDA sees supply and demand for major commodities. So if we look and see where price projections are, I've got a whole host of different agencies that are projecting prices. So if you look at USDA, they have corn at $3.60. This is marketing year average price for the upcoming marketing year. Soybeans at $8.65 and wheat at $4.40. FAPRI's out of the University of Missouri. The CBO is the Congressional Budget Office, which is what they use for a lot of their budgets for any farm programs. And then CME is the harvest month on the Chicago Exchange. So you can see 2016, we're looking at lower prices on average at the farm gate than where we've been. 367, an average out of these four different sources. Soybeans at 882 and wheat at 470. So if we look, one thing that's going to be very important as we move into the planting season is these relative prices. So when you look at this chart here, what it ends up showing is it shows the relative prices between soybeans and corn, wheat and corn, and then sorghum and corn as well. So if you look at this black line on the top, where we've got it at 253, that's what the average price relationship over this 15-year period is between soybeans and corn. So prices above the line would indicate a favorable price relationship for planting soybeans. Prices below the line would indicate a favorable pricing relationship for planting corn. Now, obviously, these aren't the only factors that goes into planting intentions, but it does end up giving you an idea of where we are right now. So currently, when you look at this, we see that corn plantings are favored for all three of these commodities. Wheat obviously doesn't affect us in the south, but it sure does up in the Dakotas and Minnesota, where they plant the spring wheat a lot of the time. Now, other things that'll play a major factor, obviously, in planted acreage is going to be the weather up there, and then input costs is another one that's going to be a determining factor. So if we look and we see where planted acreage has been and where the initial projections from the USDA are, what they end up seeing is they see wheat down about 3.5 million acres, corn up about 2 million acres, and soybeans pretty much even with last year, which would probably bear out pretty well with that last graph with the relative prices, where it did tend to favor corn a little bit. It's not to say that there's a lot of profit available in corn. It's just that it has improved relative to those other commodities. So again, when we look at how these acreages will end up be planted, weather will ultimately have the ultimate say, but right now I think we will see a little bit more corn. So what does that do for our projected production domestically? One thing that's going to be a challenge, corn markets, this will be, the last 4 years will be the 4 highest production years on record. Where they've got it projected right now is the 3rd highest, right behind 2014 and 2013. So obviously where the USDA sees initial production coming is not going to be beneficial from a supply standpoint as far as improving prices. Soybeans are down a little bit. They've readjusted their trend yields a little bit, which has dropped their production down a little bit, but it's still the 3rd largest soybean crop on record as well. The one where we've seen continuing falling of domestic supply is wheat. We've seen continued reductions in acreage and the corresponding drop in production. So what does this mean? This is a slide I really want to focus in on. What we're looking at here are ending stocks for the marketing year. So if you think 2015, that is the marketing year we are currently in. The marketing year for corn and soybeans runs from September 1st to August 31st. So the black bold 2015 numbers are the marketing year we're currently in. 2016 numbers are the initial projections for the upcoming marketing year, which would be the crop that we're looking at planting this spring, harvesting in the fall of 2016. So there's a couple of very problematic trends here for a dramatic price increase. If we look at wheat, we are looking at an almost 1 billion bushel carryover potentially in wheat. Worse than that is we're looking at that stocks to use ratio staying up around that 50%. Anytime you have large amount of stocks relative to use, it does not bode well for price. Corn, very similar trend. You can see the last 4 years we're looking, and the projected one coming up, we're looking at building stocks to where we're now estimated at 2 billion bushels for the upcoming marketing year, where stocks to use of 14.4%, compared to this past year at 1.8 at 13.6. One thing that's really been hurting the corn market and all ag markets in general has been the strength of the U.S. dollar. It's really dropped our exports to other countries. For example, wheat, this year we're projected to export right around 750 million bushels. That'll be the lowest amount of wheat we've exported from the U.S. in the past 35 years. So in my entire lifetime, what we're projected to export this year is going to be the least amount of wheat in that 35-year period. Same thing with soybeans. Soybeans, I wouldn't be surprised if they back this up a little bit due to the strength of the Brazilian crop. There's a lot of people out there that are anticipating 100 million plus metric ton crop from South America. If that is the case, the relative prices still favor Brazil, and as such, we'll lose a little bit more export market with soybeans. The good news in soybeans is that demand has been reasonably strong, both domestically and for export markets. But we have a huge crop down in South America that'll likely eat into our export share and build up our stocks, consequently bumping up our stocks to use. Again, if you look at the prices that the USDA just came out with for the 2016 crop year compared to the one we're currently in, currently wheat was projected at $5. It's down 80 cents down to $4.20, down to $3.45 from $3.60, and soybeans is down around $8.40. So now I want to shift it up a little bit, and I'm going to talk a little bit about stocks to use. So the numbers that are here on the corn chart. What I want to do is just show how there's such a strong price relationship between stocks to use and where the marketing year average price is. So each one of these points on this chart represents a marketing year combination of stocks to use, which is on the vertical axis, and price, which is on the horizontal axis. So you can see back in 2012, we had really low stocks to use. We had really high price. 2011, 2010, 2013. So where we're projected at right now for 2015 is right around that 13%, which would translate into an on-farm price average for the U.S. somewhere between $3.15 and $4.05. If we go back and take a look at where it's projected at 2016 at 14.4%, you follow the trend line, somewhere right around that $3 as far as an average price at the farm gate. So again, that's something where the bigger that stocks to use number, or bigger that stocks to use ratio gets, the more downside there is going to be in that market. But what we're looking at right now is somewhere down in that 315 to 405 range for corn. The same ratio as for soybeans as for corn. There's a couple of things that I want to point out, because you'll notice two trend lines on this graph. It's the same information where you have stocks to use on the vertical axis, price on the horizontal axis. Now what I've broken it out to is I've broken it out into two separate and distinctive trend lines. We have a longer term trend line that takes all 15 years into account, which is this bottom line. And then we have this upper vertical line. Now one thing that was brought on when we've seen a tremendous amount of production start to come out of South America, I think it kind of changed a bit of the structure as far as what we can expect for prices. So what you can see is you can see kind of a different trend line here for some subsequent years. When you look back in the early 2000s, I'm not sure if we're in the same marketing environment where this is going to be representative of what's going on. So if you look from 2005 to 2014, I think this trend line is going to be a lot closer to where our price expectations are going to be than this smaller one. So if you look at where we're at, 12.2% for 2015, that would end up translating into a price of $790 to $980. That's a big range. I understand that. But again, it's one of those ones where there's a lot of variability, given that there's only 3 countries that really produce any significant amount of soybeans. Now, if we go back, I just want to quickly go back to that 2016 number. We look at that 2016 number of 11.4. It's estimated down a little bit. I honestly think that that number is going to swell a little bit, but again, a lot of it's going to depend on how much acreage of soybeans we end up planting this coming spring. If we end up getting somewhere north of 82 or 83 million acres of soybeans, then I definitely think that we'll see this number swell maybe up into that 13-14% range. So if we look at what that would end up being, if we're up at 14%, and we're looking at somewhere around that high 7s to low 8s for soybean prices. So again, it's really important when we look at not only the supply side. The supply side is very important because we have had such large record both domestic and global supplies, but there's also the use component. And when you take those two together, it actually does bode well for predicting future prices. So if we look at what's going on in the corn market right now, we've actually been moving reasonably flat. We've kind of been trading, besides that little peak that we had back in December or in July of last year, when we had all those concerns about how much rain they were getting in Missouri and parts of the eastern corn belt. We got that nice big spike where we got up almost to 450. I don't know if we'll end up getting something like that again this year, but other than that, we've been trading pretty consistently, kind of between $3.50 and $4. Now, when we look at opportunities for the upcoming year, if we see some of these spikes that are present on this futures chart, I think those are the times when we really have to take a look at pricing at least some production. Obviously, there's many different ways. You don't have to use futures or options. You can use marketing contracts. There's plenty of different ways to end up pricing some production, but I wouldn't let some of these price spikes pass you by if we end up getting them this spring and into the growing season. Obviously, the weather's going to be a very key factor in where prices go, but if we can get some production price right around that $4 price range or above, I think we've got to take advantage of that. Obviously, for those that are down in southern Middle Tennessee, they benefit from a very strong basis down there. So you can add that local basis on top of it. But I do like looking at that futures contract as kind of setting a price target and then adjusting for your local basis, because you guys will potentially have opportunities that others won't end up having due to the strength of the basis and some of the uniqueness of the poultry industry there, which contributes to it. The other thing that I did want to point out, back in 2014, we had a harvest low. Occurred September 29th of 318 a bushel. This is on the December contract. So what I'm going to shift up to now, this is the futures market. If we look at what's going on in corn options right now. Now, I don't expect you guys to all be able to read everything on here, but where we have this dotted line, the upper dotted line is a 350 put, which right now you could purchase for 13 cents. So if you're looking at setting a futures floor, you take that 350, you minus the 13 cents off of it, and you get a 337 futures floor, which again, if you look back one slide, you're arguably looking at a similar set of circumstances as far as stocks to use ratio. So again, you're looking at possibly ending up securing against a price drop here. The big thing that I like about this is it really protects you against the downside drop on the futures side. If we put another record crop on the books, I don't think there's any doubt that we'll get below that 318 mark. And for 13 cents in an upfront premium, I think it warrants at least some consideration. The other option, and I know we've talked about this with some of the people in Sweetwater several times, is how do you offset the cost of that put option? So if you're buying a put option for 13 cents, the other thing that you could potentially look at doing is selling a call. So if you ended up looking at this 430 call, which is on this dotted line right above, it would cost you about 15 cents. So this would basically cancel out the cost of your purchasing that put option. Now, one thing that is different, if you're only buying the put option, it leaves the upside completely open. So if you end up having 450 corn, you can still end up taking advantage of that. You're just out the 13 cents. If you end up buying this or selling a call to offset the premium cost, then it does leave you exposed on the upper side, right? You can't take advantage of that big upward movement if one should occur. But currently, right now, in my opinion, there's still more downside risk in this market than there is upside potential. Now, if you look at why I think this is not a bad strategy right now, is I think likely what we'll see is we'll see over time usually just a horizontal movement or a flat trend in the market. I don't necessarily think if we have an average to below average crop production year, I think we'll see the futures markets move relatively flat unless there's some other global disturbance that's out there. So essentially what this strategy allows you to do is set in a futures floor where it'll end up taking out that downside price risk, but allow you to participate in kind of looking at compensating that premium cost to remove that downside price potential. So this is just an example. I think there's plenty of different combinations that you can look at on this board. Maybe you're not interested at a 350. Maybe you're looking something a little bit lower or something a little bit higher on the call side. But I think these are the types of opportunities that we really have to start considering to make sure that we protect ourselves. The other one that I'm not going to talk about today, but I hope everybody's in full swing doing, is getting with their crop insurance agents, making sure that they've got the protection that they want. There's several different products that are available out there, ranging from yield to revenue protection to area type products to more individual products. But I think if you start with a crop insurance policy as the base to your marketing plan, then you can start looking at some different options from there. We move on to soybeans. Again, this is kind of highlights that we're kind of on a delay on soybeans. We had the harvest low back in 2014 for corn. Our harvest low over time was 2015 so far. One thing that's concerning about the soybean markets is that we're still in a bit of a downtrend. This downtrend that we've ended up starting since back in 2013 has continued pretty persistently. We've flatlined a little bit right now after we ended up having a bit of a drop in the fall here. Again, with this Brazilian and South American production making it to market, or the bulk of it will make it to market a month to 2 months from now, I would not be surprised to see the soybean market move a little bit lower, down where it's challenging some of these lows of 840 on the futures market side. If you look at options, again, similar thing that you can end up doing, an 860 put for 29 cents, give you an 830 futures floor, 831 futures floor, and you can partly offset it by selling a call for 22 cents. So again, I think those two things are important to end up looking at, or at least considering. I think options are a nice tool. If you're just buying options, then you don't have to worry about any margin calls or anything like that. You know how much you have put on the line, and it's a maximum that you end up having. So again, I don't want to go into too much supply and demand. I think everybody's pretty aware that we've got some real challenging supply issues with the kind of a flat to slightly increasing demand. The other ones that are very important to look for 2016 is that relative value of the dollar between the Brazilian real, Argentine peso, and the Russian ruble. Obviously, for the Brazilian real, that's going to directly impact corn and soybeans. Argentina, you're looking at soybeans and corn as well as wheat, and then Russian ruble is going to impact what's going on with wheat. I don't necessarily foresee the U.S. dollar coming down relative to these. So the best we can hope for is that it moves relatively sideways and we establish a new equilibrium. Because the one thing that you have to remember is as these currencies come down, yes, it does benefit them on the price they're obtaining domestically for their product, but it really does hurt them really severely on the input cost side of things because it's an inverted relationship. So when they have to go onto the global market and start buying fertilizer in U.S. dollars, their domestic currency does not go nearly as far as it used to when it was stronger. So again, what you'll see a new equilibrium end up coming out where you're going to end up seeing a lot of these countries here where the input costs are going to rise dramatically relative to what they're getting in output. So that's something to pay attention to. The global and economic growth and stability, particularly in Southeast Asia and South America. South America is kind of politically a mess right now. Anybody that follows Brazilian politics knows that there's all kinds of corruption and economic scandals going on down there. The ag sector has reasonably made it through unscathed, but if it continues to go this way, it's going to have some repercussions down there as far as the stability of their ag sector and particularly how quickly they can accelerate their infrastructure growth. Another one I'm not going to spend any time on, but domestic policy. Obviously, we're in a presidential election campaign. There hasn't really been much of a focus on agriculture, but we'll have to see who emerges from that and what their ag policies are. On the foreign ag policy side of things, Argentina had a presidential election back in the fall of 2015. A new president ended up coming in, and they've dramatically changed their export taxes. So essentially, they eliminated all export taxes on corn and wheat, and then they came out with a plan to slowly reduce the export tax on soybeans. So essentially, what it did was ended up freeing up a new global supply source for purchasers of grains and oilseeds, which has obviously not bode well for prices. I mentioned Brazil and Argentinian production. Brazil right now is not quite 50% done their harvest. So the big question in Brazil, as always, is how quickly and efficiently can they get their production to port and off to market. There's always still some logistical issues down there, but by all accounts, it looks like it's going to be another record crop in Brazil. If we look at domestic planting, we talked about that. Weather's going to have the ultimate say, but I think we're going to see a little bit more corn, a little bit less, or about the same beans and some less wheat on that. I think we'll also see a little bit of a bump in cotton, but nothing major in Tennessee, and that'll mostly be out in West Tennessee where we have the gins. One thing I think we need to look for is start pricing early. Again, it seems to always happen every year. We get some type of a weather scare, whether it's too wet, too dry, planting's delayed, some type of frost. I think those are opportunities where if we can sneak in some pricing, I think we need to take advantage of that. If you don't have a marketing plan, I strongly encourage you to develop one. I don't think it needs to be very complicated. What I would look for is like a half a page where you can end up pointing out different prices that you're looking to market your crops at, and then also look at the timing where you want to end up having different percentages of production priced. Because one thing we want to try to avoid doing is having to sell all of our production at one time, because then we are the very definition of price takers in the ag market, which is what we don't want to end up doing. And then the last thing I just want to highlight is don't let these opportunities pass you by. When we end up seeing these spikes, and say we get up to 410 in corn, I would be very leery about holding out for 450 or 460 or whatever that number is. I think we need to be a little bit more conservative in our price expectations and make sure that we take advantage of some of these opportunities. So again, just to reaffirm this, we look at that price spike back in July of last year where we essentially got almost a 50-cent price spike. That was a 1-month window. So if you're not following these, at least on a month-to-month, but preferably on a week-to-week or day-to-day basis, you can miss these types of windows that are available to price. And again, obviously it's great to hit this one. It would be good to hit this one as well. So again, when you're looking at these, the magnitude of these price rallies, I think we really need to look or tamper or dampen our expectations of how big of a rally we could potentially end up getting. I know it's always difficult because you never know what the severity of the weather or the issue that causes the price spike is, but just looking at what the underlying supply circumstances is, I just think that you're really going to see the tops knocked off a lot of these rallies. Look at soybeans, kind of a similar thing we had back in July, but then we had that big price slide, and then we had a couple of other minor opportunities during the harvest window, and then again right at the beginning of December. So again, if you can spread out that price risk and price a little bit of production each time, I think that's very beneficial. One thing that I would end up saying is that when we end up getting these ones, we want to end up acting really quickly on them, and to make sure that we're not opening ourselves up to having to price everything all at one point in time. I had a talk up in Montgomery County yesterday, where I was talking with a group up there, and I don't mind the idea of pricing it in 10 to 20% intervals as we move through a marketing year. So again, if you look at 2016 crop, pricing some starting as early as September to December of 2015, pricing 10% in that type of a window, moving into January through March before you actually plant that crop, maybe price another 10 to 20% then, and then in early spring and into July, price another 10 to 20%. And then once that production risk is kind of moved off, pricing some additional sales before harvest. It should be the goal. Now, one thing that you do want to be very careful, depending on the marketing products that you use, is you do not want to end up exchanging price risk for production risk. So if you use a lot of cash forward contracts, you do not want to overprice, because if you don't get the production to end up fulfilling that, there's a good chance that if you ended up overpricing, you didn't have the production, that there's a lot of people in your region that probably has the same set of circumstances. So if you had to go onto the open market and buy corn to fill a cash contract, you're probably buying it at a lot higher price. So again, we need to make sure that we have that balance between the two. We want to protect against price, but we don't want to end up overpricing and end up exposing ourselves on the production end. So with that, that's all I kind of wanted to end up going through today. Just give you kind of a quick supply and demand look. There was one other thing that I really quickly wanted to end up showing. I'll just see if I can get it to bring up here. And it's a marketing tool that we ended up developing along with our budgets. So those of you that use our budgets, it's on the same page as our budgets, but it's basically a little Excel spreadsheet that was developed to give you some ideas of the different price and yield combinations that result in profitable marketing opportunities. So again, I'm just going to share this screen here with you quick, and then I'll turn it over to Andrew. Okay, so what we have here, this is just the first page of it. Essentially what I did was I took the cost of production in dollars per acre for all these different commodities, and these are straight off the UT budget. So this includes both your variable and your fixed costs. For corn, we have $512. For soybeans, $427. You can end up typing in any number you want. So if you were looking at just covering your variable cost, you can put in your variable cost there. Obviously, we want to look at covering both variable and fixed.
Hi, Aaron.
Yeah.
Aaron, Are you showing a Excel file or something?
Yep.
Change your share screen to the Excel file, because right now we're just seeing your internet.
Okay.
You got to change what you're showing.
Okay, just one sec here. Is that better?
Yep, that's it.
Okay, so what I've got here is I've got the cost of production. Thanks, Andrew. And anyhow, for corn, obviously for the budgets we have 512. And for soybeans we have 427. These are straight off the UT budgets. So again, these are going to vary for your operation. You can end up adjusting these so that you're covering variable and fixed, or you can end up covering just your straight variable costs or some combination out there. So after you've put in these numbers, so obviously you have to end up developing a budget for your operation. What you can end up looking at, and I think this is a great in-season tool to end up having. So if you look at this, what this matrix ends up showing you is along the top horizontal axis here, you have different yield combinations. It ranges from 100 to 200 bushels per acre. On this vertical axis, you have price. So obviously we know that price and yield are continuously changing. So when we're looking at, say, 350 corn and 160, what this tells you is that you're making $48 per acre. If you end up looking at all these red combinations, that's where you're not profitable. Anything that's in black is where you're seeing some profit. So again, I think this is the type of information we have to continually analyze, because as yield changes and as price changes, your different profitability is going to end up changing, right? Because ultimately, quite often we get fixated on price or yield. What we want is the combination of both and how it relates back to what you've put into the ground. So again, those are the types of things we have to end up looking at. We got the same thing for soybeans. Soybeans right now, this is obviously a little bit more skewed to having more negative values than positive values. Part of that is we've had to increase some of our chemical costs in the budgets due to dealing with some of the herbicide-resistant weed issues that are out there. So again, it's kind of expanded that cost a little bit. But anyhow, what I wanted to highlight on this is we do want to end up looking both at what the yield potential is, both good and bad, and price potential, good and bad, for different production costs that are available. And as I mentioned, this is available online.